Good morning. My name is Simone Parker, and I'm with our stakeholder relations team. It's our privilege to host today's webinar on investment returns and how they impact your contribution rates. So let's get to the panel of experts who will be here to join us. We have Chief Investment Officer Stephen Gilmore, Deputy Chief Actuary Fritzie Archuleta, and Investment Director over Investment Technology Data and Performance Rob Paterson. Today, the panelists will provide a summary of our investment performance for fiscal year 24-25, the impacts these investment returns have on our employer contributions, and will provide an overview of the upcoming board decisions regarding the asset liability management cycle. We will include a copy of the slides in the chat for you to follow along with, and we'll get that to you shortly. With that said, I will now pass the virtual microphone over to Rob Paterson to start today's presentation. Thank you.
Perfect. Thank you, Simone. And good morning, everyone. My name is Rob Paterson, and I'm pleased to walk you through the highlights of investment performance for the fiscal year ending June 30th, 2025. And so let's start with some of the most recent results. For the fiscal year, we achieved an 11.6% return, reflecting strong performance across the portfolio. And this brings our 5-year return to 8%, our 10-year return to 7.1%, and our 20-year return to 6.7%. Over the past 30 years, we've delivered a 7.6% return. So what does this mean? It means we're not just meeting our goals, we're exceeding them across multiple time periods, which ultimately strengthens the fund's long-term stability. At the same time, we recognize we're long-term investors and we need to focus on performance over decades, not just 1 year. But these results demonstrate that our strategy is working, and our ability to exceed our investment goal of 6.8% positions us well for the future. We can move to the next slide. So this slide gives us an overview of how our portfolio is allocated across asset classes and how those investments performed over the past year. On the left, you'll see the strategic asset allocation, or SAA targets, which are set by the board. And these targets give us flexibility to manage the portfolio within certain ranges. Next to that, you'll see where we're actually positioned, our actual allocations, and where we stood at the end of the fiscal year. And on the far right, you'll see the 1-year total returns for each of the asset classes. So let's look at a couple of highlights. We look at public equity, our largest asset class from a percentage standpoint, had a very strong year, returning 16.8%. And that was driven by broad global equity market gains, as well as technology-related growth. We then see private equity, which has been a consistent performer in recent years. It delivered a total return of 14.3%. And our newest asset class, private debt, delivered a solid 12.8% return, reflecting strong deployment activities and risk-adjusted returns. Fixed income returned 6.5%, and real assets returned 2.8%, with infrastructure contributing strong returns of 7.5%. It's important to note as we're looking at this that private asset valuations lag by 1 quarter. So the data for these assets is as of March 31st, 2025. This is consistent with our annual reporting practices. So nothing's changed here, but just want to remind everyone of that. And overall, all asset classes delivered positive total returns, and our diversified portfolio performed well. Move on to the next slide, please. Thank you. So as long-term investors, we focus on how our asset classes perform over time. This shows the total returns for each asset class over different time periods. So as we look at this slide, let's focus on a couple of takeaways. As we look at public equity and private equity, growth-oriented assets, they've consistently generated the highest returns, very much in line with expectations. Private debt, a newer asset class, has also been a positive contributor since its inception, and we see on the 3-year period, the longest return period we have for this asset class, posting 12%. Other asset classes like fixed income and real assets provide important diversification benefits to the portfolio. Even their returns are a bit more modest. And then as we look at the longer time horizons, what we'll notice is that the returns tend to stabilize or align more closely with our expectations, and those expectations being what we set in the 4-year ALM process. This highlights the importance of very much staying the course through the implementation of the portfolio and maintaining a long-term perspective. But what does this mean for the fund? It means that we're growing the portfolio while managing risk, which is ultimately critical for meeting our obligations. We move on to the next slide, please. So this slide breaks down how each asset class contributed to the total return for the fiscal year. We can think of this slide as being how much the strategic asset allocation, or SAA, which is also represented in the form of our benchmark, contributes to total return. And that's what we see is on the left-hand side of this chart. We then add on top of that the value add, or the active return in excess of the SAA or benchmark, which is shown on the right-hand side of the chart. And the combination of those two things is what brings us to our total return. So from an asset class perspective, we see that public equity was the largest contributor. It added 6.3% to the fund's total return. Private equity contributed 1.4%, making it the largest contributor among private asset classes. And private debt also played a significant role, contributing 70 basis points to the total return. On the right-hand side, we can see that the return had an active return or value add equal to 171 basis points. That's a return above and beyond that of the benchmark or the strategic asset allocation. 60% approximately of this value add or outperformance came from private equity, where our increased focus on co-investments has really been a key driver. When we look at co-investments, we ultimately see reduced fees and expenses, which generally translates to higher net returns. And this strategy has been instrumental in delivering value to the total fund. So in short, on this slide, really what we see is that each part of the portfolio is working together to deliver both strong absolute and relative returns for the year. We move on to the next slide, please. So when we take a step back and we look at how our actual performance compares to expectations set in our 2021 asset liability or ALM cycle, we want to see how well we're performing relative to those expectations. And so this chart ultimately shows our cumulative returns alongside the expected return. So that squiggly blue line is what we realize, that straight line is our expectation. And what we can see is that our actual performance is well within the range of those expectations, which are the bands around those two lines. This really demonstrates that our strategy is delivering results in line with the goals and expectations that we set during the last ALM cycle. Again, why is this important? Being within the expected range means that we're on track to meet our long-term obligations or objectives, even across challenging market cycles. And for anyone who's interested in additional information or a deeper dive on this, we're going to provide more information at the upcoming investment committee meeting on September 15th. And there's also a full report that's already posted to the website, along with all the board materials that's available. So with that, I'll hand it over to Stephen to discuss some of our relative strengths and also our 25-26 INVO objectives.
Thanks very much, Rob. When making investments, it's really important to understand what advantages and disadvantages you have and to lean into those advantages and try to mitigate the disadvantages. One of the big advantages we have is our size. That size allows us to engage in a wider range of activities. It also means that we're an extremely important investor to a lot of our partners. Rob mentioned what's been happening with private equity and co-investment, for instance. Our size gives us that advantage. We can be the most important or one of the most important investors for each of our general partners. And that allows us to get better access to co-investment. It also allows us to negotiate better. And that goes through to the bottom line. Also with size comes a bit of a challenge because some of the investments that we'd like to make aren't scalable. But net, size actually leads to lower costs, it leads to better access, and is a definite advantage for us. Our long horizon is also a strength. It means we can look through some of those near-term market ups and downs. And associated with that, we have good, strong liquidity, which allows us to invest in those private market assets, which can lead to better performance. It could also lead to diversification. Our brand is another strength. People know us. If we knock on the door, that door opens typically, and we can have those conversations. Another big strength is the team itself. Good, strong, broad, capable, talented team. And in combination with that team, we also have access to very diverse, important data. So we talk to a lot of people, we get that access that I mentioned, and we can learn from that and use that to our advantage when investing. Associated with that, of course, we're trying to improve our technology to better use that internal information knowledge that we have. Next slide, please. With that in mind, it's helpful just to set out what our main business objectives are for the year, and they haven't changed. It's very simple. We focus on our people, we focus on the process, and we focus on the portfolio. Together, those things should give us better performance. And when it comes to the people, I mentioned we've got a very strong team, but of course we need to invest in those team members. And we've been partnering with the enterprise human resources team to focus on succession and development. And we're also trying to strengthen collaboration across the team, because we have that information that I mentioned. Sharing that information is important to achieving our objectives. In addition, one of our main objectives is to improve our data and technology. And we have an ongoing project to modernize that investment data and technology. In some ways, it's around simplifying some of the applications we use to get better aggregated data. And Rob is one of the key participants in overseeing that. Just to reflect the importance of that initiative, both Marcy, our CEO, and I are co-sponsors for the effort. So that's an ongoing effort. It's going to take place over a period of years, and it should allow us to harness that data that we have and to allow us to manage the portfolio better. You've also heard reference to the asset liability management process. This is something that happens every 4 years. We look at the overall asset allocation. We have an interim check-in every 2 years, and we're going through this process now. And next week, you will hear us make some recommendations with respect to that asset liability management process. In this particular case, we're recommending something of a change to move away from what's referred to as a strategic asset allocation to focus more on a total portfolio approach. The main reason for that is that the total portfolio approach, where we look at optimizing the portfolio as a whole, tends to produce better outcomes. And better outcomes means better risk-adjusted returns. It should mean stronger funded ratios, lower contributions, and a more sustainable plan. So more on that next week. In addition, of course, we're focusing on sustainable investment, our 2030 plan with respect to our climate objectives. So put all those things together, we expect to have improved funded status and to make the system more sustainable. And with that, I'll pass over to Archie. To Fritzie. Sorry, Fritzie.
Archie's fine, Stephen.
No, I don't think so.
Thank you. All right, so I'm sure all of you employers out there are thinking, what does this mean for me? Oh, sorry, can we go back one slide? Thank you. This section of the webinar will give you some answers, hopefully. I will first talk about the 11.6% return and what that means for the system as a whole. And then I'll discuss the most recent valuations produced in August, and finally, how the 11.6% return rolls into future projections of those valuations. Next slide, please. So as you have seen, that 11.6% is indeed good news for you employers out there. Since our target return is 6.8%, this means that all employers will see roughly a 4.8% increase in asset returns over what was expected. These excess funds will serve to lower future contribution rates from what they otherwise would have been based on the expected 6.8% return. The funded ratio with this system has also gone up. As of June 30th, 2025, the funded ratio of the system as a whole increased to 79%. That is up from about 5% from last year. One caveat to this number is that later this year, the board will vote to update the actuarial assumptions based on our most recent actuarial study. If the recommendations put forth are adopted, we anticipate this number to drop just a bit to 78.6%. Next slide, please. Excuse me. So let's talk about timing. The 11.6% return will be realized in your June 30th, 2025 valuation. For public agencies, the June 30th, 2025 valuation will set the contribution rate for the 27-28 fiscal year. For state and school employers, the same valuation sets the contribution rate for the 26-27 fiscal year. You probably noticed also that the 11.6% return triggered a risk mitigation event. Next slide, please. As a refresher, the risk mitigation policy was put into place to help lower investment risk for the pension system whenever investment returns came in significantly above the discount rate. The way it works is shown on this slide. If the return exceeds the discount rate by 2% or more, it triggers what we call a risk mitigation event. Under the original policy, that meant that the discount rate would automatically be reduced according to the values in this table. For this year, given the 11.6% return, the excess return is 4.8%. This corresponds to the brown box highlighted in the table, indicating that the discount rate would drop by 5 basis points. Namely, the 6.8 discount rate percent that we have today would be reduced to 6.75%. However, a few years back, the board updated the policy. Now, when a risk mitigation event occurs, there is no automatic reduction to the discount rate. Instead, our team will bring the discussion to the board to determine whether changes should be made. Next slide, please. That discussion with the board will take place at the September board meeting, where they will decide on a course of action. As you know, we are in the middle of an ALM year. It makes sense that any action by the board would be aligned with the recommendations from that study rather than following the risk mitigation policy in isolation. Next slide, thank you. So what does a discount rate mean for employer contribution rates? If the discount rate does not change, there will be no immediate impact on employer contribution rates. Of course, employer rates can still change for other reasons, but those changes would be realized later down the road. If, however, the board decides to lower the discount rate, employer contribution rates would go up, and any such increase would first be reflected in the June 30th, 2025 valuation, which again affects the 27-28 fiscal year for public agencies and the 26-27 fiscal year for school employers. But what about employee contribution rates? So classic member rates are set in statute, so there will be no changes to classic member rates. But for PEPRA member contribution rates, it depends. If the discount rate does not change, there will be no immediate impact to PEPRA member contribution rates. Of course, PEPRA member contribution rates can still change in the future if assumption changes are implemented. If, however, the board decides to lower the discount rate, a 0.05% drop to the discount rate would equate to roughly 4% of plans that would see a PEPRA member contribution rate increase. And this corresponds to roughly 5% of all PEPRA actives. Any such increase would first be reflected in the 27-28 fiscal year for public agencies and the 26-27 fiscal year for school employers. So before we take a look at how the 11.6% affects your future contributions, let's review briefly where the rates are today. Last month, the Actuarial Office released the June 30th, 2024 valuations. The reports determine the employer contribution rates for the 26-27 fiscal year for public agencies and 25-26 fiscal year for school plans. These reports were released in my CalPERS in early August, and they will be posted to the public web later this month. A few key takeaways from the 2024 results. the investments earned a 9.3% return last year. Some plans had higher costs because retiree benefits are catching up with inflation. This was mostly true for plans that offer more than a 2% cost of living adjustment for retirees. We also saw salary growth put pressure on plans, which is common after periods of high inflation. This table displays the average contribution rate and funded status for safety and miscellaneous plans, as well as the school plan. You can see that the funded ratio improved slightly and that the employer contribution rates dipped just a bit. Next slide. Now I'll go over how the 11.6% return will specifically affect your rates. Here's a preview of what's to come in the June 30th, 2025 valuations. Here's a visualization of the 11.6% return. Let's say we start with $100 million in assets as of June 30th, 2024. So that's that blue bar all the way to the left. Based on our assumptions, we'd expect $106.8 million after 1 year. That is represented by the middle column. The expected asset return of $6.8 million is shown in the orange portion. But the actual returns were stronger, and we ended up with $111.6 million. The excess of $4.8 million above and beyond the assumed $6.8 million is what we call an investment gain. This is shown at the box of the columns all the way to the right. So the actuarial office will take this investment gain and apply it to lower your plan's unfunded liability when we process the June 30th, 2025 valuations. So investment gains and losses aren't applied to the contributions at once. They're actually spread out over 20 years and begin 2 years after the gain is realized for public agencies and 1 year after the gain is realized for school plans. In the chart above or in the slide, the tall blue bar represents the $4.8 million investment gain. The smaller blue bars to the right show the resulting payments from this gain. The payments are not level right away. The first payment is actually 1/5 of the fully amortized payment. The payments then start ramping up during the first 5 years of the payment before leveling off. This ramp effect smooths our ups and downs for the market returns from year to year so that employers can plan for impacts over time. The percentage points underneath the black line are the estimated contribution rate drops as a percentage of pay. This chart is based on a typical miscellaneous plan. So this chart shows the same concept as the slide before, only this is what happens for a typical safety plan. You can see that even though the amortized dollar amount payments are the same, the impact of the investment gains is larger as a percentage of pay if your plan has a higher asset to payroll ratio. Next slide, thank you. So not all plans are created equal. This chart highlights typical scenarios we might see for miscellaneous plans. Starting with the typical plan column and moving right, the table shows the asset value, the asset to volatility ratio, and the funded ratio. The columns further to the right display the resulting payment amounts due to the investment gain, starting with the first year payment and followed by the fully amortized payment once the ramp portion of the payment schedule is complete. You can see that the impact of an investment gain on employer rates depends on the unique makeup of each plan. To compare your plan to this chart, you can find your asset to volatility ratio in the maturity measures section of your report. Next slide. So this slide is a duplicate from the previous slide, only with typical scenarios for safety plans. The key points from the last slide also apply here. So the good news is we have a tool for you. This tool is called Pension Outlook. It is a projection tool which resides on the CalPERS website. Once you create a free account, you can use it to model future projections of both your funded ratio and future contribution rates. You can also model a bunch of other things, but I won't go into detail on that today. So here's a screenshot of the landing page of the tool. The assumptions you see on the screen will be populated with the default assumptions from that valuation year. As a user, you can change any of these modeling assumptions to see how those changes would affect the future funding of your plan. There's a great user guide on the web which explains the options on this page in detail. So currently, when you open Pension Outlook, it's loaded with the June 30th, 2023 results. This means that the data behind the display is all as of plan information as of 6/30/2023. The tool then uses the actuarial assumptions in place to project information into the future. Since we know what the actual return was for 23/24 and 24/25, we can update the return percentage for those years. This is illustrated by the red box on the screen. Once you make the changes, you can hit the submit button. Before we go to the next slide, I do want to point out that any day now, Pension Outlook will be updated with the June 30th, 2024 results. And so once those are updated, you no longer will have to put that 9.2% for 23/24 because it'll already be incorporated. And you would just have to put the 11.6. Okay, so next slide, please. Okay, so when you hit the submit button, this is what you're going to get. So the dark red line is the original projection of the employer contribution rate from the 2023 valuation. But the dotted orange line underneath the red line is the new projected employer rates given the 2 years of good investment returns. And the dark blue line on the original, let me back up. The dark blue line is the original projection for the plan's funded ratio as of the 2023 valuation. And the dotted lighter blue line above the dark blue line is the new funded ratio for the plan given the 2 years of good investment returns. I really love this tool because it gives you the most up-to-date projections once the annual returns are known. It also allows you to model unlimited what-if scenarios beyond the unknown returns, or beyond the known returns. So with that, I will pass the mic back to Simone.
Thanks, Fritzie. So as Fritzie mentioned earlier, we're in the middle of our formal asset liability management process, or ALM. This month, the board will receive a first reading of recommendations that will be voted on in November. These recommendations include adopting a new investment governance model of a total portfolio approach, or TPA for short, as we've been calling it, and a formal total fund risk framework consistent with a reference portfolio and active risk limits. These changes would replace our current investment governance model of a strategic asset allocation. The board will be asked to also approve a discount rate and the actuarial assumptions in the experience study. So pending the decision by the board in November, we have an ALM webinar scheduled for December 4th to go over the approved changes and what that means for you. The September board meeting materials are all posted online. And if you'd like to read more about the ALM decisions being considered by our board, you can do so there. We encourage you that you watch the upcoming board meetings scheduled for September 15th through the 17th. And if you're unable to attend in person, all of our meetings are live streamed and then recorded and posted on our YouTube channel. So we put together a slide here that has helpful resources on who to contact. So we have our stakeholder outreach mailbox here. And in addition, for your convenience, we've included links to the Pension Outlook tool mentioned in Fritzie's presentation earlier, and the report that Rob mentioned, which has the complete investment performance details in what's called the Trust Level Review Report. So at this point, we're happy to take any questions that you have. It looks like we have about 30 minutes. So if you have a question, you're welcome to raise your virtual hand and we'll call on you. While we wait for hands to be raised, it looks like we do have 2 questions in the Q&A box. So I'll start with those. So the first question, I believe, is for you, Fritzie. It says, when you say that CalPERS is 79% funded, does that mean that both classic member pool and PEPRA pools are both at 79%? Or is it a different percent for both pools? And if different, just curious, what percent of full funding is each of those pools? Thanks.
Okay, so thanks, Simone. The 79% funded is actually for the system as a whole. So we took up all the costs of the entire system and divided it by, or took all the assets for the whole system, divided it by the total cost for the whole system. And that's that 79%. So yes, if you were to look at funded ratios of different plans, they are disclosed in the individual reports. But we don't actually have, I don't actually have offhand the number between PEPR versus Classic.
Thanks, Fritzie. This one's for you as well. In Pension Outlook, are there other assumptions that are automatically updated with data from valuation 6/30/2024? Fritzie mentioned to update investment returns, only 9.6 will be auto only.
Okay, so can we go back to the Pension Outlook modelings? Just I think it'd be helpful to answer the question with that slide up. Thank you, right here. And so when you open up Pension Outlook, all of these assumptions here that you see will be defaulted to whatever was in place during that valuation. So right now it says data as of 6/30/2023. So everything here will be populated with what we assume in the 2023 valuation. But then nothing beyond that. And so you would want to put, because we know what we got in 23/24, you'd want to put a 9.2% in there because that was the return. That's what we got. And then with this new 24/25 return, you would want to put 11.6 in there. That's a done deal. And so you can put that in there to get the most up-to-date projections. Now, when we do update to 2024, you will no longer have a box that gives you what the return could be for 23/24 because we already have it incorporated. And you would just need to put that 11.6 in the very top box. So I hope that answers that question.
Thanks, Fritzie. Why don't we go to Cami? It looks like you have your hand up. Would you like to ask your question? If you take yourself off mute, you should be able to speak. Oh, you lowered your hand. Maybe that was an error. Okay. So it looks like we have two more questions though in the chat. So the first question is, why is the board considering reducing the rate of return assumption when the returns have been doing so well? So I'm not sure who wants to take this, Fritzie or Stephen.
We can probably both take it.
Okay, great.
I'll start. Typically, when you generate strong returns, you're in some ways borrowing those returns from the future. So when assets, let's say, become more expensive, the look-forward returns tend to be a bit lower. So you can't just take the historical returns and then project them forward. It's much better to look at what the yields are, what the earnings is, what, let's say for equities, price earnings multiples and so on. So as I say, you really have to be forward-looking rather than just looking at near-term sort of historical performance. So that's certainly something we take into account when we're looking at investment returns. It's something that the people who are producing capital market assumptions will take into account when looking at forward returns. But Fritzie will have some comments on this as well, because she talked about what we do when we get stronger returns in terms of thinking about the discount rate.
Thanks, Stephen. Yeah, so I just want to add that, that policy was in place a few years ago. That doesn't necessarily mean that they're going to lower the discount rate. So if the material is actually online for the board right now, and the recommendation is actually to keep the discount rate at 6.8%. But like Stephen said, we need to look at what we can reasonably assume to get in the future, and that's pretty much where we set the discount rate. And so, like he said, if you have years where you're doing really, really well, it's all cyclical, right? And so we have to weigh that into our projections as well. And so, even given all that, the recommendation is actually 6.8%. So no change.
Thank you. This question, I'm not sure if you already answered it, but I'll go ahead and read it. What would be some key reasons why the board may consider the reduction in the discount rate triggered by its original policy? And what would be a few key reasons why they would not reduce it? So Fritzie, I think that would probably be a question for you.
Sure. So we did talk about the key reasons of, what would trigger a change to the discount rate. But some of the key reasons, not necessarily to reduce it. It's always a balancing act, right? Because there are when you lower the discount rate, employer contribution rates go up as well. And so there's always a kind of balancing act when we do this, but we also really have to think about what is the most appropriate value of asset return that we're going to get in the future. And that's really kind of the biggest driving force as far as the discount rate and where we set that.
Thank you. Okay, this was a long question, but it looks like it's for you because it's about, Fritzie, it's about an actuarial report. Okay.
Okay.
So it says on page 9 of my organization's 6/30/24 actuarial report, it has investment returns over the course of years 1, prior to this updated 11% return. All but 30-year returns was below the target of 6.8 return. Is there a way where we can lock in the gains on better years to reduce the variation in down years? Even with the strong years, the discount rate was hard to achieve. And 2, the 30-year return on my report shows 7.7 return. The one you presented now shows a 7.6 return after the 11% earned in previous years. Hope that makes sense.
So I'm going to attempt to answer at least the first part of the question. And so, basically, when we look at your plans as actuaries, on June 30th, we look to see what are the costs of the plans versus, what assets you have on hand. And to the extent that they don't match up, which, they never do, you either have a surplus or an unfunded liability. Most plans are in an unfunded liability situation. We attempt to collect that back to get you back to 100% funded. And that's why you have an unfunded liability payment. And so what we do have in place to help protect employers and to get them back to 100% funding is that amortization policy. We review that every few years to make sure that, it still makes sense. Again, it's, the balancing act. Ideally, as your members retire and they work for you, you fully fund them before they retire because they're not making contributions and you're not making contributions for them anymore, right? And so every few years we look at that amortization policy to make sure that it's doing its job. And that's the way that we protect against, gains and losses in the future. So I'm not quite sure what question 2 means. It maybe is, so what's important to note is the valuation that you got is as of 6/30/2024. I think the timeline or at least the history of returns that Rob showed, like on the very first slide, that was with the new return incorporated, correct? Yeah, so the report that you have, and this is why I like Pension Outlook so much, the report that you have is all only data as of 6/30/2024. The returns displayed in the webinar on the first slide incorporated that 11.6% return.
Thanks, Fritzie.
Thanks.
And I know you like to joke that Pension Outlook is pretty cool. There's 2 more questions about it. So clearly there's people on this call that appreciate it as much as you.
This is a win because Pension Outlook is super cool. So let's see. Do you want me to read the question, Simone, or do you want to?
It's all right if you wanted to read it. That's fine.
No, go ahead.
Okay. So the first one is, does the Pension Outlook tool offer suggestions for the 115 trust contributions and how they would affect future valuations for UAL?
Okay, so Shelley, I love this question. We're always looking for suggestions to, ways that would make it more helpful for you guys. So is my email address available somewhere?
No, but we can put it in the chat.
Okay, that would be amazing. I'm always, all ears for any improvements that we can make to Pension Outlook. And so, yeah, I can't guarantee that we're going to put them in because sometimes there's logistical issues with putting that in. But yeah, I'd love to hear any suggestions that you have that would make your life easier using Pension Outlook.
And then the second question is, are we able to print the modeling scenarios from the Pension Outlook tool?
Sure. So there's 2 things that you can do in Pension Outlook. Well, first you can just screenshot it using like the snipping tool if you wanted to take a picture of the graphs themselves, or you can actually, if you say we're at a board meeting or something, just bring a laptop with you and you can run the scenarios right there. Another thing is there is an Excel download, which gives you all of the numbers. If you're like a numbers person, you don't really necessarily like the graphs that much, you can download the Excel values that are powering that graph. So there's two ways that you can do it.
Great. This is another question. It's the Fritzie show right now. If the board decides to reduce the discount rate for some reason, in what fiscal year would that first be applied?
So that's a great question. If they do decide to lower the discount rate, that would be incorporated in the June 30th, 2025 valuation. And so it would affect for public agencies the 27-28 payments. If your school plan, it's 26-27.
Okay. This one's for you as well, Fritzie. Should the returns used in the pension outlook tool be reduced by an administrative cost of 0.1%? So should we use 11.5 instead of 11.6?
Yeah, this is a super good question. This is obviously a experienced pension outlook user. I would actually use 11.6 right now. Let's just, I just usually hang out and, I mean, you can put 11.5. I don't think it's going to make that much of a difference, but I would use 11.6 right now. And then obviously in November when the ACFR comes out, we'll have the real return that you can use to update that.
Great. Okay, I think you might be off the hook. I believe this is
Yay.
a Stephen question. How do you calculate the returns on illiquid assets like private equity and real assets?
Yeah, very carefully. The reality is there are multiple ways of calculating or estimating those returns. So we do have the capital market assumption. So this is a survey of the market for the various asset classes. But we also need to think about the underlying drivers for those asset classes. So we will look at how exposed the asset classes are to growth or to inflation and so on. But also, very importantly, in our case, we may be able to get something in addition to what the market is offering. And I'll use the example of private equity. So we can look at the capital market assumptions. We can look at what we think the liquid equity market is delivering us. But as you've heard from Rob, one of the good things about the program we have in place is that we get more exposure to co-investment, and that co-investment is lower fee. So it may be there's no management fee or no carry. It depends on the particular arrangement. So that lower fee goes straight through to the bottom line. We also have made some changes with respect to the composition. So historically, we had a larger exposure to mega or large buyout, and we've tilted away from that to more middle market and to growth and venture. So when we're thinking about private equity, we're not just looking at buyout, we're looking at that other combination, and that change can also influence the prospective returns. And we think we're reasonably good at choosing managers. That can also lead to a somewhat higher return. So when we look at expected returns, we can be looking at the capital market assumptions. We could be looking at what's specific to our portfolio. The same thing would happen when it comes to, let's say, real assets. It may be we're investing in core. It may be we're investing in, let's say, value add or opportunistic, and we would have to adjust as a result of that. But Rob might have a couple of comments as well on this.
Yeah, thanks, Stephen. Maybe some additional context in terms of the mechanics of the measurement as it pertains to our experience, which is that the industry practice is the managers, the GPs generally provide some type of valuation, generally in the form of financial statement or reporting on a quarterly basis. We record those upon the date that are received, and then we mark on the day that it occurs any flows, contributions, or distributions that occur. So that's kind of the mechanics to complement more the conceptual framework that Stephen was mentioning.
Yeah, I guess that's for the actual returns.
Yeah.
But when it comes to trying to estimate what the returns are, we would triangulate. We would look at a lot of different estimates, and it will vary depending on the manager and the opportunity. So, and these things are not going to be precise. But like I said, we do have some distinct advantages in some of those areas. So we think we can do better than what the generic market is offering because of the advantages we have.
Thank you. Well, I'm not seeing any more questions in the Q&A, and I'm not seeing any additional hands raised, so I can pause a minute to make sure that we're not missing anyone. But I will just say that if for some reason there's a question that you thought of after the fact that you would like answered, I just suggest that you email this CalPERS Stakeholder Relations mailbox that's on the slide here, and we will happily work to get you a response on that. This webinar was recorded and will be posted to our YouTube page in the coming days. So if you have a colleague that you think might benefit from watching this, or you'd like to go back and view it again, you should be able to do so. You can always subscribe to our YouTube channel and you'll get notified as soon as any new videos have been posted. So with that, on behalf of myself and my fellow panelists, we appreciate you joining us today and we hope you have a wonderful day. Thank you. Bye-bye.